All right, so we have some complicated issues today. Uh, so let's yeah, I need to have some questions on the other board to talk. Okay, there are major issues. So I don't have time to talk about some small issues. So because there are just some practical issues. No, let me use. Yeah, that's it. So the first thing we want to talk today is the treasury bond futures. Then we move to the SOFR future, which originally from the euro dollar future. I guess we don't have time to talk about the duration matching, but I guess anyway, you have learned it in other courses, so we will just test it. Okay, we won't really want to talk about it that much. So the first thing is the treasury bond future. Okay, if you go to search about the treasury bond future, they have some very strange structure. Okay, like here I check it in the CME group. Right? The CME, this is the exchange for future contracts. So you can see that here they have a detailed table for those contracts. So very, very strange. You can see that one uh, okay, their deliverable maturity span from 1 and 5 years to 2 years. Like other treasury bond futures, they all have like a tolerance in the range of maturities. Like the most strange one is a T-bond future. You can see that their deliverable maturity span from 15 years to 25 years. So that means uh, for this bond future, it's quite uncertain for you to think uh, what bond you can eventually receive. Okay, you may receive a bond with a 20-year remaining, but you may receive a bond because right, it is quite uncertain. So, well, this is the major part, the major So feature I want to introduce here for treasury bond future, which is their one-to-many structure. So, okay, taking back to the slide, and well, let me alert you, the slides usually, this course slides is very, very simple, very, very brief. You cannot just understand everything using the slide alone, okay? So the basic structure for treasury bond future is like you have one future contract, but it has a basket of deliverable assets underlying it. So for this treasury bond future, it can deliver a bond with its maturity in 15 to 25 years. Okay, so this is the major of T-bond of treasury bond. Okay, just a T-bond is the one with the longest difference of maturities. Okay, so here the reason or say the necessary how is that the bond market is naturally illiquid. Okay, although right maybe after you learn some courses like the investment, like the other the financial statement analysis, you may thinking about that. Oh, bond is just another investment choice. It's just like when I determine my investment portfolio, I need to allocate enough into bond, enough into equity. Well, so in practice, some many of your bond investment are not actually happens in the market. Rather, you are just you purchasing or temporarily trying to hold the bond, trying to borrow the bond from some institutional investors. So most of your bond investment actually does not happen in the market. But there are some reasons about it because, for example, for treasury bond, they can be used as a cash equivalent. So many of the institutional investors, they keep a really ridiculous amount of treasury bond in their balance. So so that they have enough capacity to manage all their business, right? So the nature for all bond markets are that all bonds are more or less illiquid, much illiquid than the stocks and other assets. Okay, so if you check the data for corporate bonds, many of the corporate bonds they don't have a daily transaction data because for many of the days they just don't have transaction at all. For some small companies, for just a quarter or half a year without any transaction, that's very natural, you know. And this situation turns to be more severe for treasury bonds, okay, because treasury bonds have many other ways to be used, and people tend to be very reluctant into the treasury bond trading. But still, we have stock futures because we have those commodity futures. We have many, derivatives for all different type of assets. Then it turns to be very strange for us to miss bond futures just due to its illiquid nature. So here, the market's solution is that okay, if just have one future bonded with one underlying asset, will make this future unfavorable by most of the people. How about we build one future that bound into hundreds of different underlying assets? right? If you don't care about this underlying asset, maybe you care about the other underlying asset. So we have one product for covering hundreds of different assets. Okay, so this is the idea to have the Treasury bond future, to have this one-to-many structure. Okay, but once you have this one-to-many structure, yes, you facilitate the liquidity, and if you check in the website, okay, now the Treasury bond future is very well actively traded. Okay, it is much liquid than the Treasury bond itself. Okay, this turns to be a very interesting feature. So you know it's usually the if you have just a one-by-one relationship between the derivative and the underlying asset, the derivatives liquidity usually depending on the underlying asset's liquidity. Okay, if the underlying asset is very actively traded, usually your future and options also very actively traded. But for the bond futures, right, what we can observe is that usually nobody trade a bond alone in the market, but people trade very actively the bond futures in the market. So this is, you know, some progress or some very nice creation in the markets, okay, to create liquidity. Okay, well, if we think about a big picture, right, what is the purpose of a financial market, right? It's to provide liquidity to everything, right? So, for the execution or for the trading of this future, right? This one-for-many structure actually create a lot of problem, right? Then how the problem is that how can I know as a long trader or a short as a long trader, how can I know which bond will be delivered, right? You have many underlying assets, hundreds of different underlying assets. How could I know which bond I could get, right? And for the short trader, the same thing happens, right? The short trader, they prepare the bond to deliver, right? They have the cost, and they also have the question, right? So if I deliver the bond A, what is the cost of my delivery? If I deliver bond B, what is the cost of my bond B's delivery, right? Which one is the best I could deliver under the regulation, right? So the market has some strange rules to help this transaction. Okay, so the first thing, the first concept I want to introduce today is the conversion factor. Okay, so this conversion factor is some numbers to help your transaction. Okay, so let's break down the problem associated with this future. The problem associated with this future, this one-for-many structure will be mainly problematic when we have delivery. Right. So if we don't have the delivery, right? If every other thing are really settled before the closeout, before the maturity date, let's trade on the price of this future alone. That's okay. That's enough. Right. Whether the delivery of the is more beneficial to the long trader or more beneficial to the short trader, we don't need to talk about that, right? Because anyway, we just trade on some random thing, sorry, some concept. Okay, there are more, you know, ridiculous products in the market, like the meme coins, like those cryptocurrencies, like the I'm not referring to Bitcoin or Ethereum. Rather, I'm referring to some very strange coins, right? Like Bitcoins, like even Trump have his cryptocurrency now. You know those things, right? It does not have any specific underlying asset. Basically, people are just trading on some concepts. Okay, so I think anything as long as you have enough buyer and sellers, you can make the transaction, right? So the transaction alone for a future contract does not matter. The main thing happens, the main problem happens with the delivery, and it by the end affect backward of the future, right? Because anyway, how can we determine the future? We determine the future price in all the formula. We determine the future price based on the underlying assets value, right? So the delivery matters because if we have the delivery, then by thinking about the cost and the benefit in the delivery process, we can by the end thinking about what is the fair price of future in the trading, right? So to help this delivery, there is one thing called a conversion factor. This conversion factor is to modify the future price in the delivery. Okay, because the reason is that you maybe, for example, the future price you observe from the market is for example 113.5, okay, for a par value of 100. It's definitely ridiculous for you to just pay this single for all different bonds, for all different possible delivery, right? Because sometimes they deliver you with a relatively shorter maturity, they can deliver you with a relatively longer maturity, and the coupon rate can be different. The distance or the time towards the payment date can also be different. There are many factors can affect the value of the deliverable bonds. Okay, if you just pay this one single price for all possible deliverable bonds, right, this will be ridiculous. So conversion factor here, try is a factor to modify the future. Okay, let's take an example first. Okay, and then I explain you how this conversion factor. So if what you can observe from the market, so you observe the bond future price is just 90. Okay, and for the specific bond to be delivered, okay, they have the conversion factor 1.38, and also for this bond, consider about its distance toward it's a time difference from the previous coupon payment date. It's accrued interest calculated based on the Descamps convention. So then the eventual price the long trader paid for this bond should be based on the future price. Like the pay 100, you don't really pay 90 plus 3. Okay, so this is not really what you pay. Rather, you pay this 90, the conversion factor plus the accrued interest. This is the price you pay for a specific bond to be delivered. Okay, so here you can see that from this example, the first thing you can get is that perhaps the conversion factor is per bond specific. So each bond should have a specific conversion factor. And yes, this is a case for different bond, you will have different conversion factors. The true conversion factor you will use in the delivery. You can also review it when the bonds delivered are determined by the delivery date. So different bonds, okay, maybe in the basket they have different candidates. Okay, some bonds the conversion factor may be 1.2, some their conversion factor may be 1.3. That's all possible. Okay, each bond have its conversion factor because this factor is to convert this one single price to a proper price applied to a specific bond. Okay. Okay, so then we can turn to some detail of this conversion factor. Well, honestly, the conversion factor is a very strange product, a very strange tool. So this tool have many very strong and ridiculous assumption. Okay, so let's see how this factor assume in the calculation first, and then I will tell you the version necessity. Okay, so first the conversion factor set the yield curve as a flat yield curve. The yield will always be percent semi-annually. So that means the interest rate curve you need to use for discounting is just a flat one, 6% all the time for all different maturity, no matter you consider about 3 months, 1 month, 1 year, 10 years, whatever. Your yield will always be 6, okay? So take one example here, okay? If by the time for delivery, you actually determine that, let's say decide, okay? You decide that a 20, a bond with a 20-year remaining maturity will be delivered to deliver. Okay. Okay, and for this bond, you have some feature. For example, it has a 10% coupon rate, and then the coupon payment frequency also semi-annually. This part is kind of a fixed. The bond's coupon payment is not semi-annual. You believe it's semi-annual, but usually for the U.S. Treasury bonds, all of them, their coupon payment frequency is semi-annual. So for this part, you don't need to care about it. All the Treasury bonds have the same coupon payment frequency. Okay. So for this conversion factor, for this bond, the conversion factor is calculated in this way. Okay, first you use the assumption for conversion factor to do the discounting. Okay, so this bond have 20-year remaining maturity, semi-annual coupon payment. For each coupon payment date, their coupon payment is about 5%. Okay, so then for $100 face value, each coupon payment date you should get $5. Right. So for the whole year, you will get $10 for with two times, right? So this $5 will be discounted using 6%. Okay, because you have a semi-annual coupon payment date, right? So your first coupon, if it will happen 3 months later, you should discount it using 1 plus 0.3, right, rather than 6. Okay, because you're just discounting for half a year, right? Then 1 year later, you have your second coupon payment date, still 1 plus 0.03 square. Okay, so this is the PV you have, okay, using the fixed yield curve. Okay, taking them into a formula, into a modified equation. Okay, you can conclude them in this way. So for each coupon, 1.03, okay, And your power term is the number of half a year you have experience before this coupon payment. So you can sum them from 1 to 40. Okay, the total remaining maturity is 20 years, right? So semi-annual coupon payment frequency, that means you will in total have 40 coupon payment in total, okay? Then for each coupon payment, you will discount them using 1.03 with a power of the number of 6 months, the number of 6 months you have experience before this coupon payment, right? And by the end, don't forget the principal, 100, 1.03, 40. Okay, so this is the PV you calculated from this flat yield curve assumption. You will eventually get a number looks like, let me check the result. Okay, 146.23. Okay, so now this is the number. This is the present value you calculate. You calculate based on this flat yield curve assumption. Okay, so the conversion factor here you already get it actually. The conversion factor is the PV for $1 face value. Okay, so the conversion factor is 1.4623. Okay, so here you have the whole story. You have the whole story. Okay, so the conversion factor is based on a very strong assumption, a flat yield curve assumption in the discounting. And if you use this assumption to discount your PV, you get the PV for each $1 face value of the bond, then this PV will be your conversion factor. Okay? So this is a PV of $100 face value. Okay? So there are actually some other additional assumptions. So for example, first, okay, so always round down the maturity to the nearest 3 months. And second, assume the next coupon payment will happen in 6 months. Okay, so these two are kind of some other assumptions behind the conversion factor. So the first one looks like this. Okay, so if your bond, if the deliver the bond is not with 20-year maturity, but with 20-year plus 2 months. Okay, if the bond does not have an integer remaining maturity, rather it has 2 months remains, you still have the same conversion factor. Okay, because the conversion factor has this assumption say that you should round down the maturity to the nearest 3 months. Okay, we know that 1 year is a full time of 3 months, right? So 20 years is just several times of 3 months. Okay, 20 years plus 2 months. When you calculate the conversion factor, you round it down to the nearest 3 months. Okay, so you just ignore these 2 months. Okay, if the remaining maturity is 20 years plus 5 months, okay, you round it down to 20 years plus 3 months. Okay, so the purpose is that if you just use its true maturity, right, then you are PV have some other discounting factors, like you need to also multiply some one more additional discounting factors outside. Well, the conversion factor here is to use the most simplest, even ridiculous assumption to help your calculation, to help your cash payment. So they always try to simplify your calculation in different ways. Okay, so for maturity, even if you don't have an integer maturity, they let you round it down to help your calculation. Okay, so second here, the same, actually for the same reason. Maybe it's very likely that when you get the delivery, this bond is in between two coupon payment date. It's quite possible, right? So, but when you calculate the conversion factor, if you're still considering about it, oh, actually it's not, there's no 6 months until the first upcoming coupon payment, but maybe just 3 or 4 months. Well, that will make your conversion factor calculation very complicated, right? We don't have that. We don't want to spend that much time. So always, the assumption is that always assume that your next coupon payment happens in 6 months. Okay, so always you can use this formula. It's a very clean format. Okay, so like you can see that many of the assumptions. Okay, if fixed yield curve, conversion factor is the present value of $1 face value, round down to the maturity, assuming the next coupon payment date. So all the thing here make this formula apply to different bonds, even if the bonds are just in the middle of their maturity, even if the bond have no integer maturity, several days until the next coupon payment date. So the conversion factor here actually give you a uniform solution. Okay. So well, the T-bonds, T-notes futures, right? They typically have a basket of asset to be delivered, and sometimes for some bond futures, they even allowed the delivery can be made by any time during the delivery months. They also can have some more or less restrictions on the deliverable bonds. Okay, those are just factors affecting their eventual price. Okay, doesn't matter that much. You just understand that eventually the price you pay is associated with this conversion factor. That would be enough. Okay, so here this conversion factor looks very ridiculous, looks very strange, but the purpose of this factor is very clear. Is to help you jump from one single uniform price to a specific price for a specific bond. Okay, you know that move from this one single future to a very large basket of bonds, right? This move is quite a dangerous jump. Okay, this conversion factor helps you to convert the uniform price to a specific price you should apply. Okay, and that's actually not the end of the story. That's not the end of the story. So by having the conversion factor, by knowing how the conversion factor to be calculated, you can actually make it clear. So now you know the conversion factor. You know as a long trader how much you need to pay, how much you really need to pay for the underlying asset, for the deliverable bonds. Okay, but for the short trader, the story has not stopped. Okay, because for the short trader, they have their cost benefit analysis, right? For the short trader, their cost of benefit analysis is like this. First, their benefit, what they receive are quite clear, right? What they receive is exactly long traders' payment. What they receive is the future price, the settled price, multiplied with conversion factor, plus the accrual interest. Okay, this part is quite clear. But accordingly, you can also thinking about their cost, right? Because the short trader need to deliver the bond, right? So for the short trader, their whether they have the gain or lose the net gain profit, depending on how much the right. So no matter whether the short trader hold the bond at the beginning, or they just purchase the bond from the market at the delivery date. No matter which way you choose, right? Anyway, you need to complete your obligation. Okay, so for your procedure, for your obligation, right? The cost actually depending on the bond's value, right? So depending on the value of your delivered bond. So this value should be the price for for either you prepare it very early or you just purchase it at the day of delivery, right? Because you're thinking about that. Prepare it earlier, very early. You don't really know the true cost for preparation, but comes to the delivery, your analysis, right? Because comparing to the delivery, you sell this bond to the market, you will get the bond price and the accrual interest, right? So you can compare these two. Now, because it's a future contract, you definitely need to follow your obligation. You need to get this amount instead of the later this amount, right? So comparing these two, you will have your concept will have your profit or lose this way, right? Or in other ways, if you don't prepare it, if you don't have the meaning, you just have a very negative future position, and then you hold it at delivery. Then at the delivery, you just need to purchase a bond first from the market and make the delivery, right? And still your cost of purchasing is this, okay? And your net cost depending on the difference of these two, okay? So this minus this, okay? So you have accrual interest, so that profit is actually the future price multiply the conversion factor. Right, this is your net profit as a short trader. Okay, and let's recall one thing we have had before, we have had in the earlier chapters. The short trader is the one prepare the delivery, right? The short trader is the one prepare the asset to be delivered. So that means in this case, when you have multiple choices, the short trader also have the subjectivity. They also can actively choose which bond to be delivered, right? And now you have this cost benefit analysis. Okay, so reasonably, for the short trader, cost benefit analysis, they can determine that which can maximize the net profit here. Okay, so if in the pool you have just 100 choices, you have 100 bonds, Okay, for as a short trader, right, you are reasonable people, you will always choose the cheapest bond to deliver to maximize your net profit. Okay, so now this is the true end of the game. This is the true end of the game. Okay, although we have very strange thing, conversion factor, we have like a cheapest to deliver bond, but come to now, okay, you actually get the whole picture. Okay, this game is complicated, yes, but the game is clear to any of the participants. Okay, the short traders gain and lose is quite clear, very well indicated. So the short trader have one single rule to determine which bond to be delivered by the end, and also the long trader know this rule very well. Okay, so this game is still a fair game to long trader and short trader. So always, right, no matter how the rule is complicated or not, okay, always the product should have enough transparency. The product should be fair to all players. Okay, if the product offer more benefits to the long trader, right, then the long trader should kind of pay something. Always you have the trade-off, right? So for example, comparing to a future contract, right? Why the option have an option price and the long trader, the buyer of the option need to pay this price to the short trader, because holding this option comparing to hold the same future for the same asset, right? You have the right rather than the obligation. So you are in a always win stage. Okay, you cannot always enjoy the free lunch. So for this always winning options, always winning products, you need to pay enough price, enough cost to make your transaction fair. Okay, same thing apply to this bond future. This looks complicated, I understand. Okay, very assumption for conversion factor are very ridiculous, and this cost benefit analysis which determine the cheapest to deliver bond looks very complicated. But anyway, at least you can get an idea is that this method is clear, is transparent to both sides, to long trader and short trader, as long as you play it. Okay, so this is the Treasury bond future. It's a couple of very strange product. But actually all the very complicated feature comes from is one for many structure. Okay, is that it has one single feature, but it has many different underlying assets. Okay, so this is the first thing we want to talk today. Next is the euro-dollar future, or more precisely, what we are currently using in future. Okay, we talk about the euro-dollar future because now the SOFR future is basically a replication of euro-dollar future. Okay, the euro-dollar future is never used anymore because the euro-dollar future was originally designed based on LIBOR, and the LIBOR now is phased out. Right? The LIBOR is phased out by 2021. So there's no true euro-dollar future right now. Okay, although some of the products they can name themselves as a euro-dollar future, but they don't really run as the original one used to be. Okay, so instead, because we changed the benchmark from LIBOR to SOFR, so now the same product with a different benchmark, different risk-free rate reference is the so-called SOFR future. But to understand how SOFR future works, we will still use some old material about euro because it's very easy to understand. Okay, so euro-dollar future here, you can see it from its name. It's mainly developed in the Europe continent, right? Okay, so the original purpose to have this future is that because you know after the Second World War, there are several rounds of monetary system change. Okay, so then now we are in Jamaica. Okay, we which use the US dollar as the main currency in the all of our transaction. Okay, also with other major currencies, US dollar is not the only, but definitely the most important one. Okay, so this actually create a very strong demand in managing interest rate outside of the US country. Okay, so in the US, right, they have their ways by trading treasury bonds, by trading many convenient domestic products for the interest rate management. But outside the US, how can we manage our interest rate exposure to US dollars, although we are not in the US continent? Okay, so then the euro dollar future comes out. Okay, after it comes out, it soon spread into the market. So although it has a euro in the name, but it has no relationship with the euro currency. It have no relationship with the Europe countries right now. Okay, it's more like trying to emphasize that this future was originally developed outside of the U.S. Okay, so this one, the structure is actually quite simple, much simpler than treasury bond futures. Okay, much simpler. Okay. Your underlying asset is risk-free rate, and always the euro dollar are about a 3 months period. Okay, in the future. So this does not mean you have only one single euro dollar future. Okay, and please note that the future is always trying to thinking about. So a future here, you are also trying to manage the interest rate in the time period. Okay, so you, for example, about the time from May, June, July. Okay, so it's a period. 3 months is period, but it happens in the future. Okay, so for now, I'm not really sure about what the 3 months interest rate would be in 2060, in 2030. Okay, but I can trade on it. I can bet on it. Okay, so typically for one contract, you have the contract size 1 million. Make your contract have a $25 change value change according to 1 basis point change in the underlying asset value. Okay, let's see how this works. Okay, how this works. So the euro dollar futures quotation is very simple. Okay, so let's use one example to see that. Okay. Right. Okay, so the price quotation for the future is very simple. 100 minus R. Okay, the side. Okay, if your risk-free rate here is 0.2, you just use 100 minus 0.2. Okay, about the percentage here. Okay, you have 99.8. This is the price of this future. Okay, so you can also have some table looks like this. This is similar to what we have in Chapter 2 when we talk about the daily settlement of future contract. So if the first day, at the beginning, maybe at the beginning of the day, you trade on this future contract, you buy in it with a price 99.72. That means the interest rate, at least determined by the end of last day, should be 0.5 0.28. Okay, that makes your current price like 99.72, right? Last day. And then come to the end of the day, so still you made people have their trading in many the risk-free rate asset, and by the end, the true market equilibrium, indicates that the SOFR rate is actually 2.85 by the end of today. Then your euro dollar future will have a corresponding change in their value to 99.715. Okay, so basically just 100 minus this number. Okay, by ignoring the percentage sign. Okay, 100 minus this number. That's it. That's a euro dollar future contract. Okay. And the 1 unit price change for just 0.005, okay, very small amount. This will correspond to a loss of 12.5 in the contract. Okay, this is because your contract size is 1 million. So if you have 1 million here, okay, multiply with the interest rate change 0.00 this is 0.005. Okay, and don't forget that your euro dollar contract is for 3 months. So the interest rate change is not on your principal change, but as 1/4 of the scale. Okay, you need to multiply the time length here. Okay, so do this math a little bit. So 1, 2, 3, 4. 1, 2, 3, 4, you remain 100. 100 multiply 0.5, multiply 0.25, you will have 0.5. Okay, so that's a process. That's a process because the size of this contract is 1 million. So if you have, in this case, 0.5 basis point change in your reference rate, then this 0.5 interest rate change, because of the contracts about 3 months, it will actually create contract value. Okay, so scale it up a little bit. Scale it up a little bit. Say for each 1 basis point, for each 1 basis point change in the interest rate, your total contract value will change for $25. Okay, so this is the first time I have such a future contract. The design looks very simple, but yeah, what's the point? What's the point of having? Okay, so for example, assume that in a very realistic case, okay, assume that you are running a company. Okay, for example, you are running Huawei. Okay, about to sell some telecommunication devices to some country. Okay, so you will sell a very large amount. You will sell a very large amount. The product may worth 100 million US dollar. Okay, so you will sell the device to customer. The customer should pay this amount. But usually, once the amount is large enough, right, they take times, that they take some time to process, even if the counterparty can have a one-time payment. And very likely, your counterparty cannot pay them in one time. Sometimes your counterparty will ask for installment, right? So they will say, okay, how about we split it a little bit, like we cannot pay you 100 million at once, but maybe we can pay you half of them, like 50 million, 6 months later, and then pay you another 50 million 1 year later. Okay, so in that case, if they make the transaction in the future, due to the installment, maybe due to the transaction delays. Okay, so for delays, okay, you cannot immediately receive this 100 million. So if they delay this payment, you will definitely charge them more, charge them the time value of the money, right? So you cannot just receive this 100 million even you wait for 1 year. Rather, you will charge them for some interest. Okay, so typically you can charge them some interest according to the time value of money. Usually, the time value of money depending on the market interest rate. So if if your customer have a very perfect creditability, that means your customer is a risk-free customer. They have no default risk. Then at least you need to charge them the SOFR rate, right? So for the delay of you will okay. So for you, for Huawei, maybe now if you check in the market, the SOFR rate is very high. Okay, sorry, okay, that's actually a very nice deal. Like the SOFR rate can be 0.3 months, let's say 1%. Okay, because now the risk rate in the US is about 4%. So 1% of something is good. So if currently the SOFR rate is 1%, so by current time point, you will expect that, okay, also will delay the transaction to 1 year later, but I can receive more. I can receive more money. Okay, receive 100 million plus the 1% interest according to this principle. But we know that, okay, this is a very realistic example, right? We know that the US trying to cut the rate recently, at least within the recent 5 years, they will have the interest rate cut. Counterparty make the payment 1 year later and using the most updated SOFR rate at that time point to pay me the money. Maybe at that time the SOFR rate is not 1%, but 0.5%. Okay, in that case, I will be very happy. I will be very unhappy because I do expect from now. Okay, I do expect that I will receive 1% interest rate payment, but comes to the end of this year, I actually receive 0.5%. I receive half of the I expected. Right, I will be very upset. So this interest rate, market interest rate drop, actually bring me from my okay, I should do the hedging. So comes to the euro dollar future or the SOFR futures structure, you can see we know that if the future so if the future price increase, the long trader's value also increase, right? So this future price is just 100 minus R, right? So that means what? It means drop. The 100 minus R will be higher. right? So the whole logic here behind the euro-dollar future and the SOFR future is that if the interest rate is decreasing, the long trader of this contract will be benefit. Okay, so coming back to this delayed payment case, if your business as Huawei, your business with a customer will suffer some loss due to the interest rate drop, then for you, the good hedging strategy is to long the SOFR future so that the SOFR drop will bring you benefits, okay? So here, if you long the SOFR future, although the interest rate change from 1% to 0.5% will give you lose here, but you long the SOFR future, this one give you the gain that can offset your loss. Right? This is a very typical process of hedging, right? Okay. But definitely for short position, you can do it if you are about to pay, right? So and also considering you also need to consider about the length of time. Okay, if here the length of the time is not 3 months, right? You need to maybe stack the two euro-dollar futures to match with 6 months, or stack the 4 different euro-dollar futures to match with a 1 year period. Also, for the number of contract you use, right, to precisely hedge your exposure, right? You need to consider about how many contract you need to buy with it. Okay. So this is about hedging. Okay. Until now, I mix up SOFR future and euro-dollar future because they are mostly the same. Okay. And yes, they do. They are the same. Okay. So SOFR future. 3-month SOFR future is just aiming to replicate the euro future. So what you have just learned, okay, you can change your name from euro-dollar to SOFR, change the underlying reference rate from LIBOR to SOFR. That's all okay. Other rules, calculations, contract size, everything remains. But then, in addition to 3 months, there is also a 1 month SOFR future type. Okay, this one use the Fed fund rates. Okay, I hope you still have the impression about Fed fund rates, which is one reference rate from overnight bank and borrowing and lending. Okay, so this is also one reference rate when we try to measure the risk-free rate. So the 1 month SOFR future benchmarking on the Fed fund interest rate and trying to trade on that interest rate as well. So basically, the function for 1 month and 3 months are the same. Okay, they just benchmarking on the risk-free rate and to be a good tool for you to manage your interest rate risk. And you know this part is not really costly because all of the content we just talked now, it's a future contract, right? So we don't need to pay any price for the contract. For the platform we use, maybe we need to pay some transaction fee, but as long as you increase your trading volume, the transaction fee won't be a problem to you. Okay, so they are actually quite a convenient tool for people to manage their interest rate exposure. Okay, one very small, one very tiny practical difference between the euro-dollar future and the SOFR future is that the settlement date. When we talk about the 3 months period, usually the settlement date for the old euro-dollar contract is on the beginning is at the beginning. Okay, it's in this case, 2060 May to 2060, 2030 May to 2030 August. Okay, settlement, the final settlement of euro dollar future are on May, but for SOFR, although SOFR try to replicate euro dollar as much as possible, but their settlement date is on August. Yeah. Okay, but don't worry. Well, that's just some conceptual things that you just know it. That will be enough. Okay, so this example I actually already talked about it here. Just one small thing I want to mention. You can not only hedge for risk-free scenario, but you can hedge for some risky scenario, right? For example, so 200 basis point premium. Usually, this premium is based on the counterparties or the payers default risk. Okay, as long as your default risk is higher, this premium is also higher. But anyway, the premium usually is a fixed variable amount is the underlying risk-free rate, right? So still, even if you are talking about a risky scenario, it's the same. You still manage the changing one. You still manage the SOFR rate. Okay, so two more conceptual conclusion. Even for the textbook, they don't talk about the technical detail because here for the adjustment here, the technical detail is just too complicated. Here, let me just tell you the conclusion. Okay, here these two slides trying to talk about the difference of the rate then and future rate. Okay, so we used to talk about the difference between forward contract and the future contract for a single asset, right? In previous chapters, that if this asset's value have any relationship with the interest rate, okay, the forward price and the future price can be different. So here you see that we are actually talking about the interest rate futures. So definitely your underlying asset is the interest rate itself. It's not having relationship, it is the interest rate itself. So definitely the forward rate and the future rate observed with those interest rate forward and future contracts can be different. So there are some explanation like explaining according to the FRA designation and future SOFR future designation. But don't worry. If you can understand it, you try to read on it. That will definitely helpful. If you don't understand it, just get the conclusion. So here, after a very complicated mathematical calculation, what we find is that the forward rate is usually lower than the future rate. Okay, and the difference can be represented by the convexity. Okay, it is quite a coincidence after you do all the mathematical calculation. We find that there is a coincidence that the future rate is relatively higher than the forward rate, and this amount is basically the convexity you calculated from the second order partial derivative. Okay, this is one thing. The other thing is the zero curve extension. Okay, right. You can see that the zero curve is not provided by the God, right? The zero curve is always calculated from some reference. Okay, we have different reference rate to guess the zero curve. But still, in addition to them, we can do the process in a backward manner. Okay, so a backward manner here I means that I'm trying to say that when we discuss about euro dollar future, SOFR future, we say that the SOFR rate is this, and the euro dollar changing the value of per contract. So we can do it backward. For example, if after the here these two futures we talk about today, the commonality for them is that they are very liquid. They are very liquid, so you always can observe a very nice market price in the of them in the market. So how about we do it in this way? Okay, we first check the future price in the market. We definitely know that the forward use is 0.2%, right? So we know that the forward rate can be bootstrapped from zero rates. We can do the opposite, right? We can just reverse the formula we have before, okay? We can use two zero rate to calculate the. We can also use one forward rate and some short-term zero rate to calculate zero rate, right? This is still a way for bootstrapping. Just now, the bootstrapping you does not use bonds, rather the market exactly match our demand, right? Treasury bonds is risk-free, yes, but its yield is too low, right? So we cannot directly use treasury bond, although we know the method to how to use bond yield to bootstrap the zero curve from short term to long term. Here, this futures, right? They have a very high liquidity that you are fully traded in the market. Okay, then by observing the future price, then a forward rate. How about we use a forward rate to bootstrap the long-term zero curve from short term? Okay, this is another way to extend the zero curve from short term to long term, right? So this, if you do this using the euro dollar future, this is called the euro dollar zero curve. Okay. So that is why if you go to the market, you check about people's argument, people's talk about monetary policy. Sometimes they provide a table, say this is the euro dollar zero curve table, and sometimes they provide some zero curve table based on treasury bonds, and their zero curve are different. Okay, so this is the reason. You have different ways, different bootstrapping methods to get the same, to get a zero curve, but those zero curve cannot be the same. Okay, okay, so that's all for today. Let me check attendance. 陈玉，高翔 absent，黄子轩，姜文涛。Okay, that's all. Thanks.